Hi, this is Stuart Weems and welcome to this presentation. I'm going to show you how much super you need, or at least to work out how much super you need to enjoy a really comfortable retirement. But most importantly, I'm going to take you through how to maximize your super balance. Something you should be very interested in doing. It's your money. And if it's invested well and you minimize fees and just take some really basic steps throughout your working life, you can certainly maximize your retirement savings. Now, of course, the obligatory warning, this is just general advice only. Please don't go away and make some substantial changes to your super without considering whether you need specific personalized advice. It's very general, this presentation. Look, the first thing I want to talk about is a common concern by a lot of people with respect to super. You know, they just don't trust it. They don't trust the government to stop meddling with it. They think the government might change the rules often, and also they're concerned that they won't be able to access super when they really want to, or that is that their ability to retire is sort of in the government's hands rather than themselves if it's reliant particularly on super. All these fears and concerns are entirely legitimate. The government does continue to change super rules regularly. The government almost certainly will change super rules in the future as well. And also, at the moment, you can access your super when you turn 60 years of age and you're permanently retired, or 65 if you're still working. That is most certainly going to change in the future. However, if you're, late 30s or even in your 40s today, it's unlikely to change, or older than that, it's unlikely to change for you. If they do change what's called the preservation age, which is the age in which you can access super, it's more likely they're going to change it for people that are much younger, say in their 20s today, to give them plenty of time to kind of plan ahead. So if you're in your 20s, absolutely, I wouldn't be assuming that you can access super at 60. It's probably going to be later than that. However, if you're older than that, so in your late 30s or 40s or older than that, it's very unlikely they're going to change the preservation age. So if you retire at 60, you should be able to access your super. And the other thing too, whilst they do change the rules, and they will constantly change the rules, the reality is that super is always going to be really tax effective. It's most likely going to be the most tax effective environment to hold wealth in it, while you're retired or when you're retired. So whilst they might change the rules and tinker with them, and particularly for people that have a lot of money in super or a lot of wealth, whilst they might change those rules, it's still always going to be attractive. So ignore it at your own peril. It is an environment where you can build substantial wealth. So I thought it was important just to talk about some of the key rules, or at least a touch on them. So there's two types of contributions. I guess firstly, before I talk about that, there's restrictions on the amount that you can put in super. And those restrictions are there really to limit the amount of tax savings that any person can access. So there's two types of contributions. The first one is called concessional contributions. Each person could put in up to $27,500, and you can claim a tax deduction for those contributions. So you reduce your income tax liability. Concessional contributions included in this cap are your employer contributions are included. So your employer will make contributions on your behalf. You're not taxed on those contributions, but the super fund is taxed on those contributions, on those receipts of monies. So really, if you're earning $100,000 and the superannuation guarantee percentage is 11%, which it is, your employer will contribute $11,000 into super. That means that you've got $16,500 left of your cap that if you wanted to, you could put into super and claim a tax deduction and reduce your taxable income and enjoy some tax savings. As I said, concessional contributions are taxed inside super. So you pay 15% of tax on that, unless you earn over $250,000, in which case then you'll pay a total of 30% tax. There's an additional 15% tax payable if you earn over $250,000. The next type of contribution is what's called a non-concessional contribution. That's really if you move any money on an after-tax basis, so any savings that you might have, you've already paid tax on those savings because you've earned income and you pay tax, and then whatever's left over, you've saved that money. And so these are often referred to as after-tax contributions because they're coming from your own pool of assets. And you can contribute up to $110,000 as long as you've got a balance under $1.5 million, or those caps can change a little bit. There's no tax deduction, there's no personal tax deduction for non-concessional contributions, but also there's no tax inside super as well. So each person can put $27,500 plus $110,000 each year into super if they wanted to. As I said, you can access super when you're age 60 and you have permanently retired from the workforce. It's quite possible to permanently retire, start accessing super, drawing a pension, and then go back to work. There's no restrictions with respect to that. Or if you're still working, you can access super at 65 years of age. In retirement, each person can have up to $1.9 million in super. And if they convert that into what's called pension phase, which means you have to start drawing a certain amount each year, a minimum amount. You can draw more than the minimum, of course, but at least it's got to be the minimum. And so if you're aged between 60 and 65, that's 4% of your balance. Over 65 to 75, I believe off the top of my head, it's 5%, and then it increases from there on in. So if you convert $1.9 million of your super into a pension, draw 4% a year, any earnings and capital gains generated by that balance, by that $1.9 million, are completely tax-free. Any income that you pull out of super, so the 4% of your balance, is also tax-free. And so this is why it's incredibly attractive from a taxation perspective to try and have as much money into super as possible, and really to try, if you have a lot of wealth, try and get $1.9 million into super, if not by the time you retire, very close to retirement date. So what's important? Well, in terms of maximizing your balance, there's times where fees are important, where investment earnings are important, or where the contributions that you make into super are most important. Sometimes all three of those things will be really important, sometimes just a couple. So if you've got a relatively low super balance, say less than $100,000, then the two most important things are contributions and fees. Investment earnings aren't that important because your balance is relatively low. So whether you earn an extra 0.5% on $20,000 isn't really going to be here nor there. However, getting as much money into super as possible, as fast as possible, really helps you benefit from that compounding capital growth. And in fact, it's really a race from $0 to $250,000. Because once you get to $250,000, investment earnings start to contribute a lot more to the improvement of your overall balance. It's less reliant on your contributions. And then once you get to $500,000, contributions start to become immaterial. It's really then the investment earnings that will take over in terms of driving that balance. So if you've got a really low balance, really focus on paying as little fees as possible and getting as much money into super as possible. Now, between 100 and 500,000, contributions are the most important, then investment returns, but investment returns depend on the balance. So at 400,000, investment returns are probably as important as contributions. At 100,000, contributions are way more important than investment returns. And then fees after that. Typically, the fees that you'll pay in super, as long as you've only got one super account, which is certainly advisable to have, won't be that significant, particularly as you get over the balance, as long as you've, really careful about the super fund you choose. And finally, once your balance is over $500,000, returns are the most important things. Then fees and contributions actually aren't going to change your balance very much. It's really about returns mostly, and then investment fees secondly. So I write a blog every year about which industry super funds have performed the best, which ones have the lowest fees, and which super fund or super funds do I think are the best. I would advise you go and check out that blog. There'll be a link in the description to this video to the blog for 2023. But certainly if you subscribe to my blog each year, towards the end of July, possibly the start of August, I write a blog about super returns that are really going to help you make sure that you're with the right industry super fund, that you've got the best investment option, and that you're minimizing fees. And if you follow that advice, you'll go a long way to making sure that you end up with a really sizable superannuation balance. Okay, here's the golden question. How much do you need in retirement? How much super do you need to enjoy a comfortable retirement? Well, I've put this table together for you. And essentially the way to read the table is you've got to work out, how much your living expenses will be in retirement, which is the blue number on the left-hand side. Let's say it's 100,000. And then you can then work out what your super balance might be by the time you get to 60. Let's say it's $1 million. Well, we can see the intersection there is that your super will last you until 73, about 13 years. So if you want if you want to be able to spend $100,000, then you really need north of 1.5, maybe even close to 1.7. As you can see, 1.7 lasts you until 97 years of age in terms of total super balance. So this gives you a really rough idea of kind of how much you need in retirement inside super. Now, if you're not going to get there, if you're not going to have enough super, then clearly you need to be investing in other assets other than super now or as soon as possible to enjoy a really comfortable retirement. So there you go. Depending on your balance, it depends on whether contributions are most important, then fees, then investment returns, or in fact the reverse. Check out that blog to make sure that you're with a really good industry super fund. Really focus on making sure you're with a fund that's got good, solid returns and really low fees. You don't have to pay high fees to get high returns. In fact, a lot of research tends to show the most expensive funds are the underperforming funds. And then finally, work out roughly how much super you think you're going to have by the time you get to retirement. And if that's not going to be enough, then you need to start thinking about investing in alternative assets. Okay, I hope that's been really useful. If you would like to learn more, you can subscribe to my blog. The link is in the description to the video. Thanks a lot.